Welcome to part 1 of our profit sharing plan insight videos. In this video, we are going to discuss what a profit sharing plan is. A profit sharing plan is a form of a defined contribution (DC) plan that relies on employer contributions to employees' accounts. A business owner who wants to set up a profit sharing plan for the benefit of herself and her employees may make generous contributions that are tax deductible and enjoy tax-deferred growth. Let's go over the basics of profit-sharing plans. Profit-sharing plans can consist of either cash bonuses or contributions to tax-advantaged retirement accounts. For the purposes of this video, let's focus on the retirement savings side of things. A profit-sharing plan is a bit like a 401k minus the deferred salary aspect. Take a 401k, subtract the employee contributions, and keep the company match, and you've got a good idea of what a profit-sharing plan is. With a profit-sharing plan, an employer establishes and makes voluntary contributions to employees' retirement accounts. These contributions can be made from the profits of the business, hence the name, and can be suspended at the discretion of the employer. The contributions and their earnings grow tax-deferred. Only when employees begin taking distributions in retirement does Uncle Sam take a cut. Now for some profit-sharing plan rules. Employees do not contribute to profit-sharing plans. Instead, their employers establish, manage, and fund a company retirement plan on their behalf. Because this process can be complicated and requires compliance with IRS rules and audits, most business owners choose to hire a third-party administrator. Although employers may decide on a year-by-year basis whether to contribute to a profit-sharing plan for the company, their contributions must not discriminate against rank-and-file employees in favor of management. In other words, employers can skip a year or more of contributions, but they can skip specific employees. In fact, profit-sharing plans may be subject to non-discrimination audits. Using a formula to calculate shared benefits helps a company avoid the appearance of discrimination. Some employers choose the simplest method and elect to contribute a set percentage of compensation to each employee's account. Other employers choose the comp-to-comp method. With this method, an employer adds up all employee compensation. Then, for each employee, the employer divides that person's compensation by the total company compensation to get a percentage. The employer then gives the employee that same percentage of the profits that are being shared. Employee benefits in a profit-sharing plan are subject to IRS rules designed to discourage early withdrawal. As with a 401k, employees who take distributions from their profit-sharing plan's retirement account before age 59.5 will face a 10% penalty. Withdrawals will be taxed as income. The treatment of employee benefits if an employee leaves the company before retirement age varies from plan to plan. If you're currently participating in a profit-sharing plan, it's important to acquaint yourself with the details of its rules. Okay, so what are the profit-sharing plan contribution limits? The IRS sets annual limits for contributions to profit-sharing plans. For each employee, that limit is the lesser of either 100% of the participant's compensation or, for 2020, $57,000, $56,000 for 2019. Not bad, right? If you're a business owner who is setting up a profit-sharing plan, this limit applies to you as well, because these limits are much higher than with a traditional IRA. Profit-sharing plans are a good option for older workers and business owners who need to make catch-up contributions in time for retirement. Thank you for joining us for this short video, and remember to join us in part 2 for continued education on profit-sharing plans. For more information, or to better understand what your retirement plan could look like, take the questionnaire linked in the video description.